Good evening and thanks so much for joining us. The top stories today. Restaurants are under pressure as states pause reopening. Bad news for owners and customers, but we look at one survival blueprint that's just reached Congress. Banks are protecting themselves from potential loan losses. JP Morgan's just put a record bad loan provision in place. Homebuilder sentiment is soaring back to pre-pandemic highs. All three components, current sales conditions, expectations, and buyer traffic, are all positive. And Airbnb books 1 million nights in just one day. Restaurants are hurting in states that have paused reopening. But one trade group has a new survival blueprint and is asking Congress for help.
A trade group representing American restaurants estimates around 100,000 restaurants have closed over the past 2 weeks amid pandemic-related rollbacks of reopening plans. The National Restaurant Association represents about 500,000 restaurants and over 15 million food service employees. It said the nation's restaurants are on track to lose $240 billion in revenue this year. Sean Kennedy, Executive Vice President of Public Affairs for the association, said in just the past 2 weeks, state and local government mandates have shut down almost 100,000 restaurants. As COVID-19 infections and hospitalizations have surged in states like Arizona, California, and Texas, many local governments have reversed course on reopening plans. Kennedy said many restaurants have told the trade group they cannot survive the start-again, stop-again approach to operations and will permanently close. To help restaurants survive in the short term and build a foundation for long-term prosperity, the association has come up with what it calls a blueprint for restaurant survival. This is a multi-step plan that calls on Congress to help America's ailing restaurants. Measures in the blueprint include setting up a targeted restaurant recovery fund, creating a mechanism for restaurants to access a second round of Paycheck Protection Program loans, increasing liability protections for businesses, and payroll tax relief for food service industry employees.
We caught up with the Epoch Times' Tom Ozimek earlier today for more details on the plan. Tom, great to see you again. Thanks for coming on.
Great to be back, Paul.
Tom, you've been following this story. Any more details on the plan?
Well, essentially what the association is calling for under this new blueprint is an extension of the successful and popular Paycheck Protection Program, the so-called PPP. That has been available for some 8 weeks to the restaurant industry, and the association says that whatever funds were available to the restaurant industry have been depleted, and so there are calls for additional funding into this program. Another thing that is being called for is payroll tax relief. That's another one of the dimensions here, and the setting up of a targeted relief fund for the restaurant industry, something that would essentially provide some short-term liquidity to the restaurant industry to tide them over through the short-term impact of the pandemic. But there are also calls for a longer-term framework of funding, which would be an additional sort of form of relief.
And do we have any idea when any of this might start to materialize?
Well, the letter was sent just yesterday, Wednesday, to Congress, and so whatever process lawmakers have for addressing this, it's hard to say at this stage, but given the history of how quickly the administration has reacted to the needs of American businesses that have been hit hard by the pandemic, I would expect that decisions would be taken rather quickly. On the other hand, there does seem to be a reduced appetite among some lawmakers to keep sort of throwing money at the problem indiscriminately, and so I expect that there may also be a period of evaluating the impact of the current stimulus before decisions are taken on follow-up steps.
Tom, thanks so much for the update.
Thanks, Paul.
One expert on corporate debt is warning that this year's run of mega insolvencies is just getting started. NYU professor Edward Altman has one of the best-known formulas for predicting corporate bankruptcies. So far this year, more than 30 companies with liabilities over $1 billion have filed for Chapter 11. Altman says that number could double by the end of the year. And it's not just because of the pandemic. Altman says there was already a huge buildup of corporate debt by the end of last year. And although the Fed has provided unprecedented stimulus, Altman says some of the debt sold just kicks the can down the road for firms that don't deserve support. He said companies should deleverage instead of taking on more debt. And it seems banks are also worried about defaults. They're putting aside significant provisions for potential bad loans. JP Morgan, for example, reported a record $10.5 billion of provisions in the second quarter. Is it a sign of a storm ahead? I caught up with Daniel Lacalle earlier today to find out. Daniel, thanks so much for coming on.
Thank you very much. Always a pleasure.
Daniel, we see the banks, not just here in the United States, but in Europe as well, setting aside quite significant provisions for potential bad loans. What are your thoughts on that?
What we are seeing so far is the beginning of a set of provisions that are likely to increase. And the logic is very simple. Banks are being prudent and they want to set aside enough of an amount to offset the risks of rising non-performing loans and diminishing value of their asset base. Usually people tend to think that these provisions are very aggressive, but if we look at history, we can see, for example, that in the Eurozone banks, they still have about 3% of their total assets in non-performing loans. In the case of the United States, it's only 1%. So banks are intending to be prudent, and it's important, therefore, that they set aside as big an amount as possible in order to address the weakening of the balance sheet. I think that it's also important to understand that if the provisions are too large, they can always be unwound.
And do you think that a combination of the Fed and the central bank's actions at the beginning of the pandemic kind of combined with the support programs or support packages we have, mortgage support programs here in the United States, some forbearance. Do you think that the impact of the pandemic has been delayed somewhat, and maybe in the next half, for example, we might start to see these non-performing loans increase?
Yes, we have seen this in the past. Initially, the impact on non-performing loans seems relatively small because of the big incentive packages. But a solvency crisis is not solved with liquidity. And many of these stimulus packages don't address the problems of solvency that so many companies and households are getting into. And usually there's a lag of about 12 to 18 months. If you remember, for example, the crisis of the Eurozone, 2009 and 2010 seemed to be years in which there was almost no risk of a financial meltdown or of a financial crisis. Obviously, in this crisis, the situation of banks is much stronger than it was in 2009. But what we know as well is that the problems of solvency and the big rise in non-performing loans tend to happen between 12 to 18 months after the crisis hits. So that is why it's so important for banks to set aside strong amounts of provisions that allow them to cushion the blow in case that things turn nastier.
And have you seen in the data things like unemployment or different metrics like this? Have they started to catch up? Have the central banks bought the banks enough time and the economy enough time for things to spring back? Or would you have liked to see it spring back faster?
I would have expected a faster return to normality by July. If we look at, for example, jobless claims data, if we look at consumption, industrial production, they obviously show bounce and they obviously show some level of recovery. But I think that the recovery is much slower than probably we would have wanted, particularly in the employment area. And that is a key factor because, again, coming back to the credit environment, if unemployment doesn't start to come back to the levels at which it was in February, and we at the same time, for example, we see that some of the subsidies and supervised jobless schemes in the Eurozone are unwound, then the impact on consumption and the impact on solvency of households is likely to be quite severe. So we need to be at least very, very aware of the importance of the job market returning to normality as quickly as possible. In order to achieve that, governments need to pay more attention to small businesses and to newly created businesses, because those are the ones that help a very rapid recovery of the employment levels.
Daniel, thank you so much as always.
Thank you very much.
Wall Street ended lower on Thursday, with airlines and other travel-related stocks pulling indexes down. Drops from Microsoft and other tech titans also weighed down the Dow. It fell 135 points, or 0.5%. The S&P 500 lost nearly 11 points, or 0.34%, and the Nasdaq dropped around 77 points, or 0.73%. And some other new data out today. Retail sales are up for June, and the unemployment rate has fallen. Retail sales rose a solid 7.5% in June after a record 18.2% jump in May. Non-store sales, including online shopping, decreased 2.4% over the past month, but still 23.5% higher than this time last year. Weekly unemployment applications remain at 1.3%, but the unemployment rate has fallen around 2%. The number is still twice as high as during the Great Recession in 2008. And back-to-school sales could top a record-breaking $100 billion. Here's the details.
With many schools turning to online classes, parents are buying more laptops, desktops, and computer accessories. Families are expected to spend $790 on average. That's up from last year's $697. Families with college students are projected to spend $1,060. Total back-to-school spending is expected to reach over $101 billion, outdoing last year's $80.7 billion. While tech purchases will top the shopping list, the report found that parents will also be buying new clothes, just not as much as last year.
And a glimmer of hope for the hospitality industry, as Airbnb booked more than 1 million nights worth of stays in just one day. It's the first time the company's done that since early March. The bookings came from all around the world, but guests weren't looking to go too far. Around half were for destinations within 300 miles. Most bookings were outside the city for obvious reasons, with country bookings bringing in over $200 million in June. That's 25% up from the same month in previous years. A big portion of the nights booked were set to start in early August, and over half the bookings cost no more than $100, just in case you're on a budget. It's the first sign of recovery for the company after a 4-month slowdown, which the company cut a quarter of its workforce. And coming up, we talked to Praxis founder Isaac Morehouse on an interesting program. He's offering students $1,000 to drop out of college. And a European court struck down a data transfer pact between the US and the European Union. Find out how it will impact US companies after the break.
Hello there. Doesn't it feel like we're moving further away from the very values that our republic was built upon? And the media in our country has just been adding fuel to the flame, which is why you need to try the Epic Times. It's pure, honest journalism that's restoring traditional values, and it reports the news with no spin, no hidden agendas, and no false narratives. So if you want to know the truth about the FISA abuse that took place during the 2016 election, or how socialist and communist ideologies have been infiltrating our society, or how the Chinese Communist Party's cover-up led to this global outbreak, and so much more, then you need to check out the Epic Times. And for a limited time, you can try the paper yourself for a full month for just $1, and we'll send you a very special free gift. A giant timeline that's 3 feet by 4 feet, documenting the FBI's abuse of FISA spy warrants. So go to readepic.com and claim yours today.
When you look at TV networks in America, a soundbite and fight-it-out culture prevails on news and commentary programs. As a Canadian, I'm fascinated with America, and I wanted to offer American thought leaders an opportunity to share their thoughts in a deep dive format, where we can explore their ideas together. And so American Thought Leaders was born. The world's most brilliant thinkers believed that open discourse was the key to greatness. However, all around the world, we see that discourse is being stifled, and political agendas have subverted media. The Epoch Times launched its Global Thought Leaders program to bring back this great tradition of free thought. As the host of American Thought Leaders, every week I interview some of the most intriguing minds on the most pressing issues of our time. Be sure to check out our new episodes every week.
Isaac Morehouse is offering students money to drop out of college and get a practical education with Praxis. And he's so confident he'll give you your course fee back if you don't get a job within 6 months. We spoke with him earlier. Isaac, thanks so much for coming on.
Hey, thanks for having me, Paul.
Isaac, you guys are offering students about $1,000 to drop out of college and come and get an education through Praxis. Why should they do that?
Yeah, I mean, look, it's been quite a while now, I would say at least a decade, that the return on investment for a college degree is just not there. With the exception if you're going to something that legally requires a degree, you know, if you need to be a lawyer or a doctor. But for most jobs most people are getting, they think they need that degree to get in the door, and it's simply no longer the case. And so they're spending, on average, I think it's 5.5 years, an average time to graduate, and coming out with an average of $37,000, $38,000 in debt. And the average post-graduation employment rate is like under 50% within the first few months after graduating. So realizing that this isn't very valuable, the value of the degree is decreasing on the job market, you add in this COVID stuff where everybody's being told, hey, we're going to have virtual classes, just tune in on Zoom, but you're still paying full price in tuition, and a whole new market of students who were already a little skeptical and a little unsure whether this college thing was worth it for them. They're all of a sudden realizing, wait a minute, what am I actually getting for this money? And so we saw this as an opportunity at Praxis to say, hey, look, you don't have to commit to anything long term. Just take a year, take a gap year, take this year off. You really want to be sitting at home paying tens of thousands of dollars to watch Zoom classes? Go ahead and take a year off. We'll pay you $1,000 to go do the Praxis boot camp, which is all remote, and then we place you in startups where we guarantee you're going to get a job offer at the end of the program, or else you don't pay us anything. So there's very little risk, and we just wanted to kind of signal to people that we are incentivized for your career success, and we want to take this chance when people are looking at alternatives to say, come check us out.
And even before the pandemic, how did you guys innovate in order to solve some of these problems that you just listed to me?
Yeah, really, Praxis started in 2013, and it was based on a decade of my own experience working with a lot of college students who were having trouble getting jobs, and then working with a lot of business owners who were having trouble finding qualified talent. And I thought, well, something is wrong here. They would tell me all these college grads, they don't really know anything, and they don't really have anything that makes me want to interview them or hire them. And all the college students were like, I don't know what to do. I don't have any skills. Nobody wants to hire me. So we started the program with a very simple premise. If you can take 6 months of learning the most basic, valuable things in the professional world, and we focus primarily on high growth companies, startups, but not for coders, for non-technical people who are going into sales, marketing, customer success, just really good first career jobs. We can spend 6 months teaching you the basics. Then we can help place you for another 6 months in a company where you go in and you're like, I'm going in as an apprentice. I'm here to learn. I'm getting paid, but I'm not getting paid a ton because I know that I've got to learn on the job. At the end of that year, we were so confident that people would be more employable and more valuable than 4 or 5 years sitting in college classrooms. And that has proven to be true. We have put hundreds of people through the programs. The vast majority of them do not have college degrees, and they're winning jobs that say, degree required plus 3 years of experience. And 18-year-olds with no degree and no experience are winning these jobs by going through the program, learning these basic skills, and then really pitching themselves to companies and learning on the job. So we've had a lot of success with that by really just, instead of just saying, go to college and learn and then hope that that's valuable on the job market, going to the actual companies and saying, what is valuable to you? What do you want to see? And let's help people learn those things.
I'm a big fan of learning from experience and through the practical use of these skills. Isaac, thanks so much for coming on.
Hey, thanks again for having me, Paul.
After taking a huge hit in April, Homebuilder sentiment soared 14 points this month. It's now at 72. That's back to its pre-pandemic high, which is up from its lowest point of 30 during the pandemic. Numbers above 50 are considered positive, and all 3 of the housing market index components have risen to well above that level. This is due in part to the record-setting low mortgage rates. Average rates for 30-year loans have dropped below 3% for the first time in 50 years. The rate averaged 3.81% last year. New home demand is rising in rural areas and large metro areas outside the suburbs. In the European Union, top court has ruled that companies cannot store EU citizens' data on US-based servers. It cancels the Privacy Shield agreement that transnational US companies relied on to operate. The court says US laws leave EU citizens' data open to government surveillance when stored in America. For tech giants like Amazon and Facebook, it could mean spending huge amounts of money to set up new data centers in Europe, or else ending operations in EU countries. Not really an option. The case started after revelations about national surveillance by former US intelligence worker Edward Snowden. The end of the Privacy Shield means companies now have to rely on individual privacy agreements, but without a central infrastructure, it makes constructing those agreements more difficult. And up next, China says its economy is growing again, but behind the GDP numbers, there are still problems. Find out what they are after the break. Analysts had a bit of a surprise this week. Taiwan chipmaker TSMC posted earnings that far surpassed estimates. The company used to be Huawei's #1 chip producer. Analysts expected the U.S. ban on Huawei to hurt profits, but it looks like TSMC was able to find clients elsewhere.
Apple's main chipmaker raised its outlook for 2020 spending and revenue. It's counting on strong global demand on 5G phones and high-end computing. The Taiwan Semiconductor Manufacturing Co., or TSMC, is the world's largest contract chipmaker. It's now projecting more than a 20% growth in sales for the year. That's up from an earlier forecast for a rise in the mid to high teens. This week, TSMC reported net income of $4.1 billion for the June quarter. That's up from the $3.8 billion analysts expected. The chipmaker is seen as an industry leader because of its role in crafting silicon for high-powered computers and mobile devices. It signals the future for the rest of the industry. TSMC was the primary chipmaker for Huawei, but hasn't taken any new orders from the Chinese company since mid-May. Analysts expected the U.S. ban on the use of American chipmaking gear for Huawei would be a big blow for profits, but it hasn't been. TSMC's CEO told investors the supply chain will adjust. In order to drive production, TSMC will be increasing investment in factory expansion, and the company will add another $1 billion for spending on new equipment in its 2020 plan. This will take the budget up to $17 billion.
TSMC confirmed on Thursday a move to stop new orders from Huawei. The company said the decision complies with U.S. export regulations. And China says its economy rebounded in the second quarter after a severe downturn due to the pandemic. But despite the positive signs, economists say there's still plenty to be concerned about.
Chinese officials released the latest economic data. They reported 3.2% GDP growth for the second quarter compared to the same period last year. This is an improvement from the first quarter's near 7% decrease. But underneath the headline number, there's a wide range of problems. On top of the list is that Chinese officials tend to overstate GDP numbers. Also, as the Financial Times reported, the rebound was achieved by, quote, Herculean efforts from the state. China's central bank has injected hundreds of billions of dollars into its financial market, and the economy was struggling with overinvestment, a housing bubble, and mounting bad debt. Last week, China's banking regulator warned about the rise of bad loans in the near future, and last month the Chinese regime asked its banks to forego up to $200 billion in profits. The official release also shows in the first half of the year, investment by state-owned enterprises rose by 2.1%, while investment by private companies fell 7.3%. But this information was left out from the English press release. The pandemic also exacerbated the chronic underconsumption problem. On Wednesday, China reported its retail sales fell nearly 2% year-on-year, worse than analysts predicted.
And that's the latest business updates for now. Thank you so much for tuning in. We'll see you again tomorrow.